Welcome everyone to the Kendall Report, where I share my 42 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, yesterday was pretty much unexpected. It was all about Brainerd talking about shrinking the balance sheet, raising rates faster, all of that. Maybe what he was doing, I'm going to go into the riff right away tonight, was giving a warning signal what we're going to see in those minutes. I think there's a big argument going on in the Fed that is, they're panicked. And people have been arguing with me going back, they weren't going to raise rates, they weren't going to do these things. The reality is they have no choice but to do these things. The dog is finally going to wag the tail. The markets are forcing their hand, and watching the 10-year print up well above up to 256, right? And it's pushing even higher, and it's not going to stop there. We're possibly heading to the 318 level. And all of this is because of one thing. It's all about inflation. It's all about all of the money that's still in the system. I'm just trying to get a handle on this. They're still putting money in the system. So they've got to downsize the sheet. They've got to do some really drastic stuff. Now, you have to remember, I'm an old guy. I was around when Paul Volcker, I actually had started in the markets in September of 1979, right around the same time that Volcker came in and was asked to beat the inflation. And at that time, we had the stagflation. We were in a recession. We had incredible high inflation. Interest rates actually went all the way to around 16 3/4 on the long bond, the 30-year bond. And Fed funds were actually around 16.5, 17 as well. But they had a surcharge. If you hit the discount window too often, you had a 4% surcharge, and that was just about everybody at that time. There was not a lot of liquidity. It was interesting. The dialogue of the day was that the Fed was going to be competing for all the capital out there, so it was going to squeeze the bond market. They were going to keep raising rates to attract capital. And it's interesting, we have actually kind of the inverse happening at a very low rate. And of course, we know that everything was held at an artificial low rate for a very long time. And now we're seeing the effects of it. And I'll go through the details here in a minute on the 10-year, but the inversion is happening is actually, I have to get some more data. I don't have really long data, but I can tell you this inversion is getting very, very big, especially on the 530s. And that, as you know, is what I'm watching. And like I said, I'll go through that in a minute. But I think what's going on here is they're trying to do that transparency thing where they're telling us kind of what's going to happen before it happens. They were telling us that we're going to see higher inflation. You remember when it was transitory? Remember when some of you that watch this channel all the time were telling me, no, it is transitory. No, it's not. And it's going to be around for a while. I always talk about the truck stop that I have to drive by to come over to my office over here. Gas prices aren't budging at all. They're exactly where they were 2 weeks ago. And so even though we see fluctuations in the markets and the wholesale markets, we're not seeing anything reflected out in the real market. And so this is really having a multiple effect. And I kind of miss the opportunity that I used to have to go in those long rants on the live stream on Wednesday. I miss that a lot, actually. It gave me an opportunity to go into more of in depth in some of these thoughts that I have. But it's interesting just to see what's going on here from the standpoint of them trying to give us information ahead of time. So we'll see. When I say the Fed minutes are lurking, they're lurking like coming out of the shadow, and we're going to find out maybe some interesting things that what the acceleration might look like. But I think they would be a lot smarter to do it like Paul Volcker and just do intermediate meeting raises, announcements just on a on a Saturday night when no one can do anything, and they're drastic. They did that in COVID. Remember, on I believe it was March 9th. It was Sunday, and they announced all this bond purchases, and they were going to liquefy the market. They did that when the market was closed, right? And what was the effects of that? Think about what those effects were. They were drastic. Markets opened up, there was crazy volatility, and that was the signal for the bottom and that they were going to liquefy everything. And we know the results of that. We're sitting here. The first thing I'm going to do tonight is talk a little bit more about that quarterly chart that I mentioned. I said I would cover this even Tuesday or Wednesday night, so I'm going to cover that tonight here in a few minutes. But the bottom line is that the Fed does not want to surprise the market, and they're not going to be effective until they do. And they should know this. I think we have just a lot of folks out there just don't have the guts to do their job anymore. And that's a big problem. You have to realize I'm old school. My dad was a World War II vet. So, I was raised by the old school, and that's just how it continues with me. A lot of that stuff still hangs on. Do your job, and I think they're having a hard time doing their job anymore. So let's just talk a little bit about what happened yesterday. I thought the sell-off was relentless. It was one of those days. There were a couple trades intraday. I'll show you a couple charts and that we use in the live trading room, and it's using I'm going to feature a little bit of TradingView tonight instead of always using TradeStation, just showing you the indicators and some of these setups that we have. But I think that we're going to be exposed to even more volatility again. I was just talking about last night, if we could get a close and break, we might get that maybe a rally up over in the 46 handle. That didn't happen, right? Got rejected. The NASDAQ got rejected right at the resistance point where it needed to break out in spite of the PPMs expanding. And we see this all the time intraday if you were in the live trading room, where all of a sudden these algos come in and they just hammer the bid, and they're relentless, and they come wave after wave after wave. That was yesterday, and that also happens on a larger scale when we see some of these charts and some of these markets get to some key levels on the charts, and I think we saw that. So I'll try to unpack this the best I can. So one of the things that is baffling me right now is that utilities, I guess they're calling it, I'm doing air quotes here, right? Air quotes, defensive sectors, right? Utilities is one of those, healthcare, and there's a whole list that they call defensive sectors. But in the end, utilities is an interest-sensitive sector. And it shouldn't be in this type of environment, I don't think it should be considered or should be getting the bid like it is. So maybe, just maybe, there's actually an opportunity there for some of those stocks. There might be some trades, contra-trend trades to what you've been seeing there. So if you're doing options and things like that, look at the utilities for some opportunities, maybe on the short side, because it looks like it's getting a little extended from my viewpoint. Okay, let's talk a little bit. Yesterday we were down 1.3 on the S&P. NASDAQ was down 2.4, Russell down 2.3. Big moves on the downside. We had some news come out, but nothing really big. The ISM non-manufacturing came in at 58.3. I don't think anyone really cared about that, but it was just all about these comments coming from the Fed. And I think the markets interpreted them the way that I'm suggesting they did, is that they're front running us, letting us know it's not very pretty what you're going to see. So let's go ahead and take a look at the database and see and get into tonight's details. So we're looking at the daily database here. We got 248 buys, 952 sells. We were up around 66% bullish. We're back to 61, 62. I've been talking about that's where we typically will stall. There's a rotation that happens. We should come back into mid 50s. So that means there should be some stable, I don't know if we'll call it stabilization. There should be some distribution to start to happen here. Some of these symbols will start to tail off, and we should probably see the database get back into around 55, maybe 52%. If it goes much below that, we're going to end up challenging even more trends. And I've talked about this quite a bit, is that we're not getting any traction on our intermediate models. And I've been questioning that. And I'm thinking, well, maybe we need to stabilize and stay here. You know, we're still above 4,500, right? So as long as we stay above those numbers, maybe 45, 46, maybe we still get the stability enough to start to get a rotation into our intermediate models. But just maybe, and I've seen this happen. I've been watching this database literally since 1998 through every cycle. And just maybe what we're seeing here is it's not getting traction for a reason, that there's still a lot of downward pressure that's out there. So in a minute, I'm going to go through the long-term viewpoint again, just bring out some other things. So maybe I got a little late start tonight. I had a technology glitch, but everything's running fine now. But I'll just go through the S&P long-term here next. Let's do that. Okay, so we'll come into trading view, and I've got our indicators on here. There's primarily what I have is just some basic moving averages that I use. There's 10, 21, 40, and 200 day, or in this case, 200 period. And these are, every bar on this chart is 3 months. This chart we're looking at actually goes back, if I just bring it a little bit more here, that goes back to the 1870 level. And this is where 1-2 is the 1929 crash. So we'll just come up to more current viewpoint. One of the things that's happening, I just want you to look at the PPMs. And I cover these all the time, but we're starting to get penetrations of the first derivatives on PPM 1 and PPM 2. PPM 3, it won't take much, but what this is telling us is that there's a rising probability that we're going to come down into the 10 period moving average. Right now, that number is 3358. It is rising about 100 points per quarter. So that's going to still be under, around 3,800. I've talked about that number. There's some numbers on the monthly charts. But this is a really important to understand that we are starting to lose substantial momentum. The last time that we had this type of scenario happen was all the way over here at the .com bust, right? So if I've got a cursor here on the page so you can see this. This is where the last rollover is the top of the three, but this is even more ominous because in real terms, if we start to think about the implications, if I have this wave count right, this is the grand super cycle, the big daddy. If this is wave 5, and if we enter into completing this and get confirmation of that, then the expectation, this is a crazy thing to talk about. And I told you I would talk a little longer term sometime this week. And this is what I'm doing right now, is the crazy expectation is typically when a wave 5 finishes, you retrace back to wave 4 of previous degree, right? So that number is the lows of 2009. That's 6666 on the S&P. Now, that's a pretty crazy number. It's I don't believe that's what's going to happen. I think more than likely what we'll do is come into the 10-period moving average, and we'll see something happen from there, from the standpoint of some stability along these lines, as long as we maintain some good upward angle of attack. And I think you can see the angle of attack pretty good. I just want to draw just a couple more things. We'll move on to the short-term analysis. But this is what I talk about all the time. This is the angle of attack of these moving averages. And I don't have the WaveTech 200 on here. In fact, let me throw that on because that'll take just a second to do it. So these are the scripts. I'll go to WaveTech 200. It's on the bottom now. And so let me draw this back in one more time. So this angle of attack that we're getting here off of these moving averages here are starting to falter. So right now, this is their current angle, and this type of angle suggests that markets will come down and hold those values. And as long as we're above, actually about 1% here on a quarterly, we're going to be okay, about 1.5 actually. On these longer term charts, I actually moved the decimal over. So this is like a 0.34 number instead of a 3.41. But what we're seeing here is the potential for the 10-period moving average to roll over. And with this crossover happening on PPM 1 and 2, this suggests that we will ultimately test that 10-quarter moving average. Whether it's 2 quarters or 3 quarters from now, we will see the markets most likely test that number. So there's going to be a sideways bound, as I've been talking about for a while. And that's going to be the pattern that we're likely going to see, is continued choppy above 4,000, below 4,800, 5,000. I told you that, I've got all the odds on my side. Jim Cramer's bullish right now. He's telling us there's going to be a bottom. Had to be within 2 days that after he said that we start to get a decline. But that's all joking aside. This pattern that's out there is very significant. This is from a long-term analysis. These are really hard because we don't get the answer until next year, right? We get some answers in June. We get another answer if we get another quarter down. We've seen in the past several years, we've seen maybe 1 quarter down. We got that in 2000. We know that got saved by the Fed. We have the setup right now for the Fed so far behind the curve with inflation and everything they have to deal with right now that they're going to have no choice but to pull everything back to save any kind of credibility. Not that they have any at all, but they're going to have to do that to be able to move this needle at all on the inflation side. So it's going to get really interesting. I think volatility is going to start to increase. Whether I don't necessarily see us like retesting the 2020 low, but I do see us coming back into these moving averages, and there's some monthly moving averages. So I warned you folks going back, I think about 2 months ago now, after January, that this was going to be an ongoing dialogue I was going to have with you on the longer term viewpoint. When we get back to looking at the daily chart, so I'm going to go to TradeStation here in a minute, we're just going to be back into the flow, the ebbs and flows of the days and the weeks and all of that stuff. But on a bigger scale, this is a pattern that's unfolding that I think is becoming more and more ominous by the day. And I think we're going to see more mistakes made by the Fed. They're going to compound things. They tried to jaw bonus and tell us that, it was transitory inflation. I wasn't buying into it. It was too easy to see that it wasn't. Now it's getting embedded in the system, and they're going to have a hard time. This could be a multi-year situation. It really could. Whether it stays at 10% or if it moderates, it's going to be really big. They're talking about wages being up 5.5%. Well, what does that do when inflation is 10? those numbers are tell the whole story, right? All right, so let's get into some of the shorter term stuff here. So we'll go over here and take a look at this is weekly. Let me get you over to the daily chart here. We'll start here. Yesterday, we traded down to the STX number that was 45.12. We printed a low of 45.07, so we printed through it. We're trading right now at 45.12. Looking at the numbers for tonight, S1 45.05. We've had a low of 45.10. Yesterday, I thought we might get an S2. Well, everything collapsed, so we got much more than that. I thought we could hesitate just a bit, but this was much bigger than I expected from that standpoint. We still have the long position that I talked about last night that we came on over here at 43.84. That's still long, but it's going to come into question. The 21 period moving average right now is at 44.40, and I was starting to give up on the ideas of trading down to 44.60, the possibility of 44.80 to 44.60. This PPM2 is up at 0.38, and that's still a very bullish number in spite of the sell-off we have yesterday. We're coming in right now with 44.40. STX today is 44.57. So the extreme today puts us also back toward the 200-day moving average. I thought we could move back to the 200. That is 44.57, 44.60 number. That's what it looked like we could do. Whether we can follow through tomorrow or not, I still think we're in the sideways range. I think the 200 is going to be the major support. It also is being backed up with some of the Fibonacci expectations as well. And you'll see one of these dots down below here. This is Fibonacci projections, and it's right now the first Fibonacci is at 43.50, so it's 100 points plus underneath that 44.60 number. But we're also seeing that PPM3 rollover. I talked a bit about that last night, which is going to act as somewhat of potentially of a magnet if we get through the 21 period moving average. But right now with a 0.38 PPM, that's probably not likely. We should hold at those levels, maybe set up a few more days of consolidation, see what happens here. But the downside, for the most part, is probably to that 200. Still going to call it 44.80, 44.60 on the downside. For today, just looking at we're probably looking R1 45.35. S2 is 44.89. That would put us right into that zone. So if we did follow through and get a bounce out of there, look for some kind of a bounce. So those of you in the live room tomorrow will be focusing in on trying to find some type of stability in the markets and looking to trade off of those levels tomorrow. Next market is the NASDAQ. NASDAQ had a hugely ugly day yesterday. We traded down the STX 14,853. Low was 14,828. We closed, I'm sorry, that was the close. So we actually got an RTX buy. So we should go sideways for a couple of days. Same patterns that are in the S&P. 21 period moving average, 14,398. We'll call it 14,4 is major support there. We should start to set it up. We've got also the downward Fibonacci patterns being projected down here at 13,800 as well. Let me bring up one chart here. And let's bring up the NASDAQ. I wanted you to see this. I just released yesterday. This is the Fibonacci projection tool in TradingView now. And so you can see these numbers that are also right there. That's the same numbers that we were just talking about. So we're also seeing, like I said, we closed under the STX number. So everything is set up for at least a couple of days sideways and some stability. There still could be some slight follow through on the downside as we come into today. But look for a potential reversal off of that lower level. Next market we'll look at is Russell. The Russell also was an STX buy signal. 2070 was STX yesterday. We're looking at a close at 2046. Should come in sideways. We'll look at the range for tomorrow. It's on the screen here. That is looking at probably the downside is right around 2037 S1, S2, possibility of an R1. That's about all we're expecting to get from this is some sideways. But what we're seeing here on the PPMs, they've rolled over substantially on PPM 1 and 2. 1 and 3. PPM 2 is still trying to hang on to a trend mode, but it's deteriorating or trying to deteriorate even further. Let me bring up the futures to get a print off of that for tonight so we can see the effect. So the 10 period PPM 1 is actually ticking up. PPM 2 is down ticking. PPM 3 is following. So there's nothing really here. We're down 0.11, nothing material of any sort, but we do have a couple moving averages, 2049 and 2033. Those are probably should represent the support. I talked a little bit about that in the last couple of nights where we're coming back into those moving averages. They've got a hold here. If we see any further deterioration, then there's a possibility of the markets moving down into a next level. There are no Fibonacci projections on the futures at the moment for the Russell. All right, the next market is the 10-year. This is a crazy number. I thought we would stay sideways. I did expect to stay above the 10. The acceleration yesterday, everything came, I think, on the comments of Brainerd saying that they were going to raise rates even faster. They were going to take the punch bowl away. They were going to start to downsize and start the runoff. And that was enough to get markets to really accelerate. We're seeing some acceleration on, this is the daily. On the weekly, I'll show you here in a minute. But this is just continuing on the patterns that we've been talking about. We're 0.77, 1.73 ppm 1 and 2. So these are really big numbers. Let's go to the weekly. We're staying within the grid. We did get that RTX sell signal. We were down last week. Now we're back up at the higher end. Right now, 2.54, 2.59. So we're pushing up toward the RTX number. But look at the PPMs here. Plus 3.81, 2.60, 1.76. And this rising 10, this is a pattern that I discuss all the time. The rising 10 is going to come into the market grid, not this week, but next. And that's going to be your primary, what I call demand line. In this case, it will be supply line because this is interest rates going up and bonds going down. So we're looking at that number is going up about 8 10 basis points per week. So we're going to be right into that area next week. So that's going to be now all of a sudden 230, 235 is going to be major support and all that. I showed you these numbers before, but I'm going to go over to the monthly because I think it's time to get a little longer term on the interest rates. I talked about this number before. You'll see the Fibonacci projections here. Let me expand this out so you can see it just a little better. Is that we had 3 projections here. I'll show those to you here. 2.38, call it 2.39, 2.87, and 3.16. The 3.16 puts, this is the taper tantrum highs, 3.23, so basically 3.25. We could be heading for those numbers right now. And so let me zoom back out and let's get a little, maybe a little more dramatic here. Is all of a sudden you could be looking at a swing pattern here that would suggest even much higher prices. So what is it? What does this mean? It means that the Fed is going to have to really. So if we start looking at these numbers here that are being projected, are coming off of this first pattern right here, and I got a lot of arrows here. Let me clean it up. But this first sequence off the lows right here, this is where these numbers are being calculated from this bar here, and this is where 1 and 3 is equal, 1.382 and 1.618. So these are the projections. That puts us up at 3%. Seems kind of wild. Look at the PPMs. These are numbers that are just completely off the map. And so typically we get, these indicators don't really get what I would call overbought. They're not an oversold, overbought indicator, but we are seeing that the strength in PPM2 and PPM3 now are just accelerating, which suggests that this angle of attack that I talk about is going to be in play. And it's going to be in play for not the next 2 months, but maybe for the next 12 or more. So this is not going away anytime soon. And all this tells me from this viewpoint is that we're going to have that inflation monster hanging around. And I'm not sure raising rates is going to fix anything, but the only thing it will fix is it will definitely take down the economy. And this is going to be a really tough year because it's an election year, it's midterms, and it's going to get really, really interesting, folks. That's all I can tell you. I think everything that we've seen in the last 2 years, maybe the last 8 years, is coming even more into context, especially with as far as the Federal Reserve goes. And right now with the tactics that are going on with the current administration, this stuff is blowing up in their face. So this is going to be an interesting scenario. How high is high in interest rates? I don't know. I've talked about a while ago. On our VPN Partners website, I used to do annual reports, spent a lot of time doing written reports. I'm going to pull down the report. I'll have to bring that up sometime soon on one of the live casts so we can talk about. But one of the things I talked about was the implosion of the retirement systems, primarily with the states. And I think we're coming to a point where if rates spike too fast, they're going to blow up. And in fact, rates went down really, really fast. If you recall, when one of the scenarios over the last couple of years, and some of the inverse bond that were supposed to, go up when the bonds are going down. Well, when prices were going down and yields are going up, there were about 6 of these inverse ETFs that absolutely blew up. And I know that people got maybe 30 cents on the dollar on some of these things. So be careful when doing some of these inverses. I'm just telling you, I've seen this stuff happen And I've personally been involved with one of these inverses that blew up. That was a hedge on some municipal bonds, and it's not a pretty sight to see. And the creator of that was Barclays. You think that was a safe place? It was ugly what they did. And it's not as bad as the LME, okay? But it was pretty ugly. All right, let's move on here. So next market we'll cover, I'll just stay with the long-term monthly. I think this is kind of interesting by accident to bring this up. We're looking at 101 on crude oil, and we look at the monthly, we're staying above the 200-month moving average. That might be the magic number here from the standpoint of support levels. That right now is at 98, 92. I've been talking about this for probably 2 weeks now, that the crude should hold around 98, probably 109. We should just waffle in there. Let's come a little more down to earth and take a look at the weekly. You'll see this pattern. There's that rising 10-period moving average in the market grid. This is a classic for me. I've been watching this pattern for a lot of years, and we've got PPMs at plus 1.84 in PPM 1. So that number right now is 99.85. We printed a bit below that on a weekly basis. We got down to 98.05. We're back above it. We look at the market grid for the weekly. We're looking at 106.86 is R2. We printed 05.59. Let's go to daily. And I just remembered I did not show you the inversion on the 10-year. So if you hang out to the end, I'll go back and I do want to show that chart. So as we look at the daily, the 40-day moving average is 101.07. That's got PPMs are trying to turn up. It's still in trend mode, 0.39, but we've got the 10 and 21 period moving averages in downtrend mode. So the overhead resistance is going to be 104.5. I'm going to round these numbers off to 105. That's going to be your downward resistance. Otherwise, we're going to get rejected off those levels. But I think this range is going to get tighter over the next several days, and then ultimately maybe there's a decision to go in a direction. I don't think it'll be down, but anything's possible in the world we live in. So, but this will stabilize. We've seen this type of pattern before. We had this happen over at right here. I've got my cursor here. If you can see it with the box here, there's a line. But right over here, when we were at the lows before around 93 bucks, the PPMs were about in the same position, and we got reversals. So be careful. Watch for reversals out of this range. I think we're capped out at probably about 109. Next market I cover is gold. Back on daily, gold will continue just to kind of waffle sideways. We're back below the averages. PPMs are starting to roll over. Talked about this pattern down here. There is a downward Fibonacci projection for 1788 on gold. I don't think it's very realistic at the moment, but the deterioration in PPM 2 and 3 and PPM 1 is starting to follow, is putting us in a downtrend mode. So it's very likely that we could end up coming down and testing some of these lower numbers, 1880, 1860, and at that point, we're going to be able to evaluate the long term. Let's go, speaking of long term, let's just go straight to the monthly, because there is some things there that I was looking at that also are important to keep in mind. Now, I've got a signal here for this month, the month of April, to be a cycle low. So as long as we stay above these moving averages, 18, 42, 48, we should be in pretty good position for setting up a cycle low bottom. And so there's that in itself also tells us there is some potential downside on the longer term charts. So be cautious with that if you're trading it. Keep all this stuff in mind. Final market I'll cover tonight is Bitcoin. Bitcoin continues to be stable above the numbers I've been talking about. The key numbers here of 43.5. So far, the low's been 44.449. So we're staying above that 43.5, which is S2. It's also the 21 period moving average, 44.357. We've got to hold these levels for this market to be in position to even rally. So maybe with everything's going on with interest rates, everything, maybe Bitcoin emerges again as an alternative. Not sure. The PPM1 is very positive. That suggests that there's the major support is 41.8, and that level should hold regardless, since this is a weekly. That'll be a solid number. If you trade down there, that's actually a buying opportunity from that standpoint. Let's take a quick look at the dailies. So dailies, this chart updates here in about a couple hours here. We're looking at the dailies are trading down toward the extreme STX 44.8, the low 44.449, so traded through it. Currently trading 45.250, so we're just above the STX level on a daily, but the PPMs are starting to deteriorate here, and there is some minor projections here for prices going down to around, we're going to call it 43.2, 41.3, and the extreme 41.20. That's going to be the numbers to watch on this. It's on the screen here inside the tab. So that's going to be the numbers to watch from that standpoint. So I would be very cautious from that. Okay, folks, come back on screen for a minute. I am going to show you that yield curve that I promised earlier, because this is a pretty drastic move, to say the least. And I'm going to see actually how far back my database will go. So let's take a look at that. So the 530 spread, this is the monthly chart. I'm just going to see what kind of data I have. Let me just see if I can get how far the data will go back. Okay, this will take just a second here. Oh, it's not going to be easy. So we'll just stick with this. This goes back to 2000. But this, once again, I'll just reference this point again. Minus 0.098. We are now looking at 11.12 here. This is a big inversion. And if I would say that it's not just the inversion that matters, it's also if it stays inverted, right? So this, we're looking at a monthly chart. If we remain inverted, I would say for at least another 3 or 4 weeks, and we remain in these inverted levels, that's going to have more of an impact than if we just spike and come back. And that's the big debate out there right now, is what does this inverted yield curve means? And I think I'll just go back and what I was talking about and talking about the Fed is that the Fed's stuck here. They're going to have to do whatever it takes to get this inflation under control. So I think the only way they're going to fix the inflation is through recession. That's about the only thing. You've got to slow the economy down. You basically have to kill demand. There's no other way around it. And to keep things, everything's going to keep going like it is. I don't think so. I have no idea what we're up against from that standpoint, at least at the moment. I haven't carried the thoughts out far enough so I'm not going to come up. I'm usually not a disaster scenario guy that's out here on the internet. I try to play what I can see and what it means for the foreseeable future, which might mean for the next quarter or two when I do the longer term ideas, because that's all we really get to trade. We can't trade 5 years from now. I'm not Kathy Woods. I don't have a special, view of the world and I know what's going to happen in 3 to 5 years. I have no clue. But I do have an idea what's likely to happen next 3 to 5 months. And that's what we can also trade, and we can make decisions about our portfolios. We make decisions about where we're placing money and what we're doing with our lives in those shorter term windows. I know that a lot of guys and smart people, don't get me wrong, the Ray Dalios of the world and the 200-year cycles, it's all BS, right? It doesn't matter. Only thing that we can do is actually trade what we know and make decisions about this foreseeable future. So when people talk, even when I talk about what's going to happen, anything else outside of that is intellectual BS for me, because I can't trade it, right? And I know I do a lot of short-term trading, all that kind of stuff, but the bottom line is I have to trade what I know, and there's no way to know anything beyond a certain point. And if you claim you do, I've been around a long time. I've seen it all. I've watched Harry Dent be bearish for the last 20 years. So I understand how it works, right? So I'm just telling you, these, be careful, and the windows that you do. The best thing that ever happened probably is a lot of folks have gotten into options. Doesn't mean they're making money, but they now know there's a window of expiration. And in my past, and when I was running a brokerage business, I used to always say, if it doesn't expire, I don't own it, okay? Everything I did was derivatives for many, many years. And I still have that vision of the world, the next option cycle and the next whatever. Those are the things that we can actually take actionable items about. So anyway, folks, I just want to thank you for being part of this channel, letting me ramble on, and that you folks are listening to me. So I appreciate it. Make sure you make comments, like these videos, share them, do all that stuff. I would like to see us start to grow the community again. We got over 30,000, getting close to 31, but I think we should be much, much bigger. And I'm going to be switching up some things here in the near-term future, where I'm going to have different, instead of doing basic same thing every night, I'm going to start to flip it up. I think I'm going to have a night where I cover the basics of what's going on in the markets, and maybe cover top 5, top 10 stocks, maybe start to bring in stocks. But if you folks will comment and tell me what you'd like to see me do, that would be really cool, because that would give me much more guidance in what is likely and what I should be doing. So anyway, as always, thank you. Have a great day. I'll see you folks that have got the indicators. I'm just putting this on screen here because it's easier to see. This is the link to get the indicators. I think we've had some great comments, people using them. You get also get a free month to the live room, so you get to be in there. The other day we used these a lot. I figured out how to get a level 2 screen on the same chart and be able to trade and show trades and stuff. So we'll be doing that tomorrow. Anyway, thanks again, everyone. I'll see you tomorrow night on YouTube. Those of you in the live room, see you at 1 o'clock Eastern time. Thanks a lot. Have a great evening. Good day trading.